Hello, everyone. My name is Peter Willem. I'm a senior associate advisor with Francis Financial, and I'm really excited to talk with you a little bit about what our views are for the market as part of our series of checking in with you on that monthly basis and giving you a little bit of an overview. And to preface before I get into some of the events today and what we want to go over, that we're going to take a step back from talking about what's happening on a month-to-month basis and look and see what do these market downturns mean in respect to the long term? When we look at some of the things that are impacting the market right now, inflation, interest rates, the invasion of Russia into Ukraine, might say this is unprecedented. The market cannot possibly recover from this. There's no way, there's no optimism, but I'm here to hit the brakes a little bit and say, yes, we do know that there are these factors that are impacting the market in a negative way in the short term, but our goal is to look and say, okay, one thing that is not unprecedented are losses within the market. At any point in time, even in years that are tremendous, we do see that the market does experience some volatility, even within very strong years. So I want to take today to really focus and say, what do markets fluctuate and how do they fluctuate on any given year? And it's easy to look at the market and say, it's down, so it's going to be down, and there's no way that it can ever come up. And it's natural for investors to look at losses in the short term and see these big flashing red numbers and say, can only continue to go down from here. And because it's been a negative handful of months, it has to be a negative year. However, if we look from a general perspective, we can see that that's not necessarily true. 17 of the last 20 years have been positive years, and that's 85%. And even in years that are positive, we see that there are stark negative returns on a year-to-year basis as recently as 2020. And we can see that very well highlighted in this graph. So what this graph is showing is that there are three things to keep track of. There's years where there are positive returns, so that's that 17 out of 20. There are years that are negative returns, which is this dark blue, which is 3 out of 20. And then these red dots show how much the market declined at any given point. So this is US large company stocks. From the top of the market, how much did it fall from that point at any given year? And you'll see losses of 10, 20, even 35%. These are not particularly uncommon. And even in periods where we do experience significant losses, like for instance, 2020, we saw that in March, there were significant pullbacks. When the pandemic started, there was so much uncertainty, this idea that it was unprecedented and it can only lead to negative effects in the market. We saw that pullback. However, the entire year isn't limited to a month or 2 months or 3 months. It is a 12-month period. So if we take a larger view and start to expand out, how does that 35% relate to how the market ended up performing towards the end of the year? And you'll see if we got too caught up in that moment when the market was down, we don't get to enjoy the rise back up. We'll see that 2020 ended up being a positive year. And that is an extreme case, but this isn't uncommon from the last 20 years in total. Years that were negative and had negative bouts did not necessarily mean that the entire year was negative. And even if it is, we often see that it's followed by very strong years. And I think it's natural to say, well, Peter, this is only 20 years. There's many, many more years that are captured by the stock right now. I would have to agree, of course. There's data that goes back to the 1920s. So let's take an even further step out to say, okay, there are losses that exist in the market and there are gains, but let's take an even wider approach. And we'll see that on an annualized basis, the market gains 10.2%. And even when there are years where there are losses, there are sometimes years that are followed by significant gains. So this is a really great graph that I like to reference because it shows in very clear terms how many years based on return there are. So in total, there were 72 years since 1926, 72, where the stock market was up. And in contrast, 24 years were down. That's about 75 to 25. That means 3/4 of the time you're going to have a year where the stock market is up by various degrees. Sometimes it's as low as 1%. Usually when it's up somewhere between 10 to in the 20s. But unfortunately, it's great that there are more often than not years that are up, but it's not uncommon that we experience negative years where there are pullbacks. So even though within the year, this is not a full year yet, and downturns do not necessarily lead to down years. However, in the event that this is a down year and the market stays down 10, 15%, we see that double-digit losses are not too uncommon. They do happen from time to time, and it is part of a healthy market cycle to have these periods where we're not always going to have these gains. And even in these periods where there are losses, it's important to have that perspective to say, yes, losses do occur, but let's continue to focus on what the potential of the market is and what we've seen more often than not, which are years that increase the value of the portfolio, increase the market. It's not getting too caught up in the short term and what could be potential losses, and focus on the macro. What's happened over longer periods of time? Because at least at Francis at Financial, we focus and we invest for that long term. So seeing this gives us a lot of faith and conviction not to get too caught up in some of the uncertainties of the moment, not to look too much at these rising inflation, not to look at these interest rates, not to look at the war in Russia and Ukraine and say, yes, these things are happening and these things do have impact on the market, but a lot of things have impact on the market. Geopolitical events are not uncommon. We can look back at the trade war, fears of the recession in 2018. These are things that did impact the market, that created a down year at the time that ended up being flavors of the moment. So at Francis Financial, we always want to encourage that disciplined long-term approach to be able to enjoy longer-term, stronger returns. Thank you so much for listening. And please let me know if you have any questions, and feel free to reach out, and have a wonderful rest of your day.